Okay, everybody, welcome. It's April 6th and we're working on chapter 7. And it's important that you study the concepts in this chapter. I took a look over the test questions and there's some important concepts here for finance and accounting, but we're not going to get as deep into them as you would in later classes. So when you're going through this, make sure you're reading it carefully, especially those first 3 or 4 modules. Also remember you need to do the reading quiz today, and it's due by, I believe, 11:55 p.m. So make sure you take that quiz today, and you'll find that the classwork that we're practicing here in Zoom won't match up exactly with the classwork that you have in Pearson. The one in Pearson should be much easier. We're learning a little bit more in the class, but we're only going to be testing on a portion of it. So your focus for studying on the exam should come from the classwork in Pearson. This will be a much deeper understanding. Okay, so I'm going to share with you now our notes, and this are available on Blackboard, and once I'm done with this, they'll be available on Blackboard as well. And so today is 4.6, 2020, and this is section 05. Okay, so we're talking about classifying liabilities, and there's 2 types of liabilities. You have current, to be paid within 1 year or 1 operating cycle, and non-current, and that'll be paid beyond 1 year or 1 operating cycle. And note that I'll also use long-term interchangeably, and it's okay if you do as well. Now, initially we're going to be talking about definitely determinable. And these are liabilities that the exact amount can be determined. But companies must record all liabilities to the best of their ability. So later we'll talk about estimates. That are not definitely determinable. Okay, we're also going to talk about bonds, and these are a legal document similar to stock, except they're debt. And bonds are usually issued to the public. So even though private companies can issue bonds, they become subject to the SEC rules and GAAP filing requirements for their financial statements. If they issue bonds to the public. Bonds usually pay interest at a stated rate on the face of the document or certificate. Okay. Now, we're also going to walk through the calculation of some of this. You'll remember, hopefully, that interest is principal times rate times time. And so we'll be using that. The quantitative questions that I'm going to focus on here are the ones that I think you haven't seen before, are a little bit more in depth. And I'll try to highlight the types of questions that'll be on the exam as we kind of bump into them. This first section that we're going to get into is about pay and wage liabilities and payroll taxes. And so this is definitely something that's going to be on the exam, so you'll want to pay attention to that. And some of the terms that you'll need to know would be gross pay. And this is sort of the salary or wage an employee earns before any deductions. Then we have OASDI, and OASDI is sort of the federal act that put into place Social Security. No, don't start it. And Medicare. And so FICA is Social Security, and the employer pays 6.2%, 6.2%, and the employee pays 6.2% withheld from their pay. Medicare, the employer pays 1.45%, and the employee pays 1.45% withheld from pay. And then you have net pay, and this is gross pay less withholdings, including FICA, Medicare, and or taxes. And so that's the other thing that would be withheld would be federal, state, and local taxes, if applicable. Are withheld from pay. So the way it works, a company in the US essentially pays a worker let's see, I got that a little bit. Company in the US pays a worker. So gross wages. Then they deduct taxes, deduct FICA and Medicare, and then they pay the employee the net pay. They pay their portion of FICA and Medicare with the employee portion to the government, U.S. government. Okay. So I'm going to make sure that's clear. It's a little weird for me to be talking and typing at the same time. And so I'm going to ask if you have any questions through that first part. If you do, click yes and type it in the chat. If you don't, click no. If you need to talk at all, just click on the chat and I'll unmute you. Okay, I see someone has a question, but nothing in the chat yet. And so I'll give another few seconds here before I move on to the next part. Okay, so I shared those results with you, and then I'm gonna close that down. Okay, so somebody said, if you work at $15 an hour, are the deductions from that 15? So the answer is yes. All right, so let's hop into an example here. And so we have the example with Bo Brentley, number one. It says he earned $60,000 from his job at Bridgestone Tires. And so this would be like $15 an hour, just over the full year working a ton of hours. So we've got 60,000, and that's, oops, I'm trying to bold it. This is the gross pay. All right. And then he had 15% withheld for federal taxes. So that's the federal taxes. And then, of course, 6.2 for FICA and 1.45% for Medicare taxes. So they want to know net pay. So we've got gross pay, oops, 60,000. Federal taxes, that's 9,000. And how we calculate that is 60,000 multiplied by 0.15. And we've got FICA, 3,720. And we calculate that, take the 60,000 and multiply by 0.062. And then we take the Medicare, and I have to punch that up. Is 870. And that's 60,000 times 0.0145. All right. We total those up. And we have to subtract federal taxes, FICA, and Medicare. And we end up with 46,410. So this answer is B. Now, just real quick, if we're talking about 1 hour, so let's just say 15 per hour, essentially here, 15 per hour, 2.25 would be your taxes, because that's the 15%. And then I have to multiply that. Hold on, let's just check out. Okay, clear, okay. 15 times 0.062 is 0.93 in FICA, and that's the 6.2%. So that's 15 times 0.0145. Oops. Sorry, I'm slow on the calculator here. That would be about 22 cents. And so if you are looking at it on like a per hour rate, just take a second here to pull up that calculation. 15 minus 2.25 minus 0.93 minus 0.22. And so your net pay is about 11.6 if you were just talking about 1 hour. Okay, so I've got a couple questions in the chat here. Would it work if you added all the percentages together? The answer is yes. Where does a 2.25 come from? So someone asked the question, what about if they made $15 per hour? And so what I did was I took just the $15 per hour, and so 15% of 15 is 2.25, 6.2% of 15, and 1.45 of 15. So this is just kind of an hourly example here. And this part, unfortunately, I can't highlight the whole thing, but that was based on a question that was asked. And so it is definitely separate from the question, but highlights what would, an example of what you would earn if you earn $15 an hour. Your federal tax might be slightly different on the withholding, but that's approximately what it was. Okay, so that. All right, so that was not part of our question. Okay. And I just put it up there because somebody asked a separate question. All right. So let's take a look at number 2. Let's scroll down. So everybody's favorite cartoon character, Homer Simpson, worked for Springfield Power and earned $5,000. Federal income tax withholding is 15%, FICA 6.2, 1.45. But the question says, how much cash will Springfield Power pay the government for FICA because of Homer's December earnings? All right. So here, Springfield Power is the company. The company pays FICA for the employee for what was held for the employee and the employer percentage. So 6.2% and 6.2%. So we take the 5,000, we multiply it by 6.2%, and that equals 310. And then we multiply that by 2, and it equals $620. So your answer here is $620. And it's the cash paid, not the employer expense. And I have a question, so let me take a second to read that. Okay. So the question would be, is this part of the question? So yeah, this is related to 7.2. And then why did I multiply by 2? Because they pay 6.2% for the employee and 6.2% for the employer. And so I multiplied by 2 because they pay 6.2% and 6.2%. I could have done or 5,000 times 12.4%. And they both would have come out to $620. Okay. Okay. So just a quick note. Springfield Power's expense in this question would equal $5,000 wages or salary expense, and then $310 FICA. Okay. Okay, so somebody's confused about the employer expense being 6.2% and the employee pays 6.2%. So the federal government requires with FICA that the employee pay part of it and the employer pay part of it. So going back up to take a look at it, you're, as an employee, the company pays the worker gross wages, and then they deduct taxes at whatever percentage, and then they deduct FICA and Medicare. So that 6.2% is the FICA. So 6.2% right now, and Medicare 1.45%. And then they pay the employee the net pay. But in addition to, so the company then pays their portion of FICA and Medicare, so they match it, FICA and Medicare, to the US government. And their FICA and Medicare for wages is 6.2%, and Medicare is 1.45%. So in total, the government is receiving, so the government receives 12.4% of pay for FICA and 2.9% for Medicare. Correct. So somebody asked, it said instead of the company paying the employee and then the employee paying FICA, the company just cuts out the middleman and gives FICA to the government. So essentially it's paid to a bank, which then gets paid into the government. Okay. All right. So hopefully that's not muddied the water at all. And that makes sense. Any other questions before I move on to the next part? Okay, so the chat's quiet now. I just want to make a note up here. So when they deduct this, okay, and I also want to make one other note up here with Social Security and Medicare. For those that are self-employed, they have to pay the full 12.4% and 2.9% to the US government. Okay. Okay, so now I want you to take a look at 7-3, and I want you to take just a minute and categorize these. You don't have to send me the answers, just categorize them on your paper. And it'll give you an idea if you kind of have the current, non-current liabilities correct in your head. Okay, so we want to know whether or not it's a current liability, a long-term liability, or neither. So it says amount owed employees for work performed in the last week of December 2011. Essentially, they're trying to trip you up here because it's going to be paid. It was due in the last week of December. They earned it, and it's going to get paid in 2012. But the year is within a calendar year or a running year. So even though it switches to 2012, it's still current. Same thing with a loan payment due in 2012. And then utilities, which won't be known until the next month. And then a 3-year note payable would be long-term. Okay. All right, so moving on to question 7.4. I had a question about the difference between current and long-term. I'll kind of refer you back to the top of it, and I'll come back to it at the end of class. Okay, so I'm not ignoring your question. All right, so now we have the following information from LoJack Corporation for the last pay period. And it says the employees will not be paid till 2012. And they want to know what amount on the balance sheet will be reported as wages payable. And so this is the gross, or no, excuse me, this is the net pay. So I want you to calculate that, number one for question 7.4, and type it into me privately. Good, got one answer so far and it's correct. Evan, check your number there. I think you might have mistyped a key. Good, okay. Most of you are getting it. I'm gonna go ahead and throw it in up here. And so net pay would be $256,755. So that's the answer to part 1. Part 2, determine the amount of the income statement will report as wage expense from this pay period. So this is the gross pay. And so that's $330,000. What type of liability is wages payable? So it's going to be paid within 1 year. So it is a current liability. And then to what party must the company pay FICA taxes? That would be the US government. Usually the Treasury. But it is paid to a bank and the bank forwards it to the Treasury. Okay. All right, so I'm going to throw up the poll here and see if there are any other questions. While I'm doing that, I'm going to leave this here for 1 second, and then I'm going to scroll up to the current versus non-current or long-term. All right, so I'm going to put up that poll. And ask you to take a, if you have any questions, click on yes and type it in the chat. And then for those of you that had questions about current versus non-current, you can see it here on the sheet. One person said they had a question, but didn't type anything in the chat yet. So when they type it in the chat, I will respond to it. Wages are always due within 1 year. There are some circumstances where it's long-term, but typically the companies will pay that out in the short term as well. Okay, so just sharing those results with you. Good participation today. All right. So even when it has like a pension, that liability goes into the pension, or if it's a 401k, then they pay into that. So now we get into estimating liabilities. And so there are some liabilities that occur in the period but are not definitely determinable. And so we have to estimate those liabilities to the best of management's ability. And the reason why, hopefully you remember this now, the matching principle. And our expenses should match the period when the revenue is reported. All right, and so in the example, the main one in the text is you recording warranty expense. Are the unpaid warranties that come with the product. And so in our accounting records, we record the sale, cost of goods sold, and the warranty, liability, and expense. Okay, so looking at the first example there. All right. In the first month of business, Fishnets Inc. sold 8,000 nets with a 3-month warranty for $10 each. Fishnets estimates that 1% of its sales will be uncollectible. So that's related to bad debts. And the warranty costs will be $100 on its sales. Okay. So we have to calculate the warranty. Here we have to record warranty expense, liability, and bad debts expense / allowance for doubtful accounts. So warranty expense and the liability is equal to $100 because that's given. The bad debts expense allowance for uncollectible that's equal to 1% of sales on account. So we go back and we look and it says all of this was on account. And so we have 8,000 nets times $10 sales price equals 80,000 in sales revenue. So we multiply that by 0.01 and that gives us $800 for bad debt expense or allowance for bad debts. And so we look up and it says bad debts expense of 800 and warranty expense of 100 on its income statement. And so that's where the answer is correct. The rest of them are incorrect. Okay. Now we're going to move to the effect of transactions on the accounting equation and I'm stretching this out a little bit. I'm going to try to get it all on one page here in a second. Okay. All right. Matt's Rug Company began business on January 1, 2011. So we know that it doesn't have any prior balances. And so we have to go ahead and record the information given. So we have $100,000 in accounts receivable because it was all on account. And then we have to reduce our inventory by 60,000. Okay. We have to record in retained earnings 100,000 in revenue and 60,000 in cost of goods sold. Okay. It expects that warranty expenses will be 6% of sales. So we take our $100,000 sales and we multiply that by 6%. And that equals $6,000 warranty liability. And $6,000, oops, not 96, 6,000 in warranty expense. All right. And then part 3 pays 4,000 in cash for warranty obligation. So this is $4,000 in cash reduction, and we're reducing the liability here, $4,000 warranty liability. So at the end of the year, the company's going to have the following costs on their financial, or excuse me, following amounts on their financial statements. Warranty expense would be 6,000. And that's going to be on the financial statement, on the income statement. The estimated warranty liability will be 2,000. And that 2,000 comes from what's remaining in the warranty liability category here. So that's 6,000 warranty expense minus the 4,000 paid. And so that's where that 2,000 comes from. And that liability is recorded on the balance sheet. Sales of 100,000. That's on the income statement. Cash paid for warranty obligations would be 4,000. And that's on the statement of cash flows in the operating section. All right, so I ran through 2 questions. I'm going to throw up the poll. See if you guys have any questions. If you do, type it in the chat. If you don't have any questions, click on no. Are you guys not seeing the poll? Yeah. All right, let's do this. Hold on one second. Let me try one more time. How's that? Still no poll? Oh, there we go. Now you guys can see it. Awesome. Appreciate you guys hanging in there when it's a little glitchy. Okay, so it looks like there's no questions here, so I'm going to end that poll. I'll share the results real quick. Stop that, and we'll move on to the last question for today. Oh, I guess that was it. So we're going to jump into bonds in the next class. If you have any other questions, you can type them into the chat. If I didn't answer that question for you on current versus non-current, you can take a peek up at the top again. And then anything else, let me know. Otherwise, have a great day, and I'll see you on Wednesday.